Welcome back, everybody. This is WealthWise on Biz Talk Today TV, and I'm Jeff Hirsch, your host. Thanks for tuning in. I'll be joining you here every week on Fridays after the New York close. I'll run through my some recent market action and what's on my radar. Then I'll dive into my featured guest interview. This week, my old friend Barry Ritholtz joins me to chat about his brand new book, How Not to Invest, the Ideas, Numbers, and Behaviors That Destroy Wealth and How to Avoid Them. We'll also dig into how he built one of the fastest growing RIAs in America and what's got his dander up these days, or whatever else we get to. Barry and I are old friends. So seasonally, take a quick look here. I'll pull up a chart for us. We had some issues here in March. We took some flack last week on the Twitter sphere. I put out two seemingly contradictory posts at Almanac Trader. I know Barry's pretty familiar with, cognitive dissonance and things that are oppose each other. But one of the posts was about this typical March chart I have here, that the Ides of March bounce might continue. And then a couple of days later, I put out that the end of March, end of Q1, has seen some mean hits the last 3 or 4 trading days. This is updated as of today's close. So end of Q1, end of March is prone to weakness. Both happened clearly. This ran a little bit further. Then we had the weakness here. March is a volatile month for the market, especially the end of the month, frequently with wild swings in both directions. End of the quarter, portfolio restructuring has been exacerbated by inflation fears, economic uncertainty, all with respect to the continued shakeup in D.C. Kind of a typical post-election year Q1 weak spot. We've got these challenging tariff negotiation tactics, along with unprecedented actions to cut waste in the federal government. That's created a high degree of uncertainty on Wall Street. This has also put the first quarter of 2025 on the verge of being negative. Right now, at today's close, with 1 day left, the S&P is down minus 5.1%. I did a piece in the newsletter last night that went out to subscribers. When Q1 is down, it can lead to more trouble. If Q1 is negative and we're not in a bear market, or we're real close to a recent high, kind of like we are now, mostly further trouble happened with the market, downside action over the subsequent 9 months. So that's one of the things we're concerned about. Let's just take a quick look at my post-election year chart. Again, there's no way to sugarcoat it here. The post-election year woes exist, and they continue to persist. Unless the market can get back into the green, the bullish scenario that I put out for 8 to 12% gains, a base case in 2025, becomes harder to achieve. You can see more about this on page 28 of the Stock Traders Almanac 2025, where we're tracking these weaker Republican post-election year and incumbent party loss tracks in the pink line and the sort of brown and bluish line. This is the 53 to 81 line, where Republican administrations really had trouble back in the pre-85 years. And then this is the average of all of them. Again, not a lot of upside. We're looking at flat to down for the year if this continues this way. So unless the market can rebound here in April, we're up for some tough sledding through the third quarter at least. Here we are at the end of the best 6 months. We're preparing for the worst 6 months, May through October. Our seasonal MACD sell signal can occur for Dow S&P anytime on or after April 1st. That's next week. So with the best 6 months here in the red, it suggests there are more powerful forces at play. While I expect a bounce here in April, or if the market can have a little turn the next couple of days, we'll see one. It brings the words of the late, great Edson Gould, who wrote a newsletter called Findings and Forecasts. His words sort of loom large in my head. He said, if the market does not rally as it should during bullish seasonal periods, it's a sign that other forces are stronger. And then when the seasonal period ends, those forces will really have their say. So I'm concerned. Big number today, PCE, disappointed. I've got the headline chart up here because that's what we track. But everyone got freaked out about the core being above expectations, spooking stocks today. Core was a month over month increased 0.4% in February, putting the annual rate at 2.8, both higher than expected. The headline This number here, which includes food and energy, was a little bit tamer, not much, 0.3, kind of just a little bit. It was like 0.33, just a little above expectations, 2.5% for the year. But this pace is worrisome also. You can see this projection here on this chart. If we continue at this at this 0.3% pace per month, we're going to be ramping up inflation again here. So it's got the market's concerned. Consumer spending also accelerated at only 0.4% for the month, down from 0.5 for the forecast from 0.5. So there's clear concerns here with the economy and inflation that the Fed's going to be worried about. The market's worried about clearly as well. Technically, I know I got one of my busy charts up here, lots of lines, but I kind of think that way. I've drawn the bounce clearly has faded here. Today's close down on here. We're down at like what 58, 55.80. I think was roughly around the close. And there's this April 24 low, the August 24 low, and I got this line, trend line that we're sort of getting close to. We almost bounced off that in earlier March. And then there's this sort of trouble zone, this resistance zone between the old July highs and the election gap breakout here in the orange. And I just sort of highlighted this in yellow here to give you an idea. But it would be encouraging if we can test and hold this March low around 5,500 and bounce up through this resistance at 57.75, what the traders call or what was known as a W123 swing bottom. If we don't get through this middle part of the W, that's some trouble. If these March lows hold and we get through, we can get back to some more bullish behavior. But with what's going on in the world right now, the market's got to prove itself. Sentiment, just a quick look at my favorite sentiment indicator. I know Barry's got some thoughts about contrary sentiment indicators. He and I have discussed this over the years. It looks like the bulls came back a little early after, we had this bearishness across the board, not just Investors Intelligence, but AAII and other sentiment measures. It looked like we were getting into that area where lows, or bottoms can be reached or turns can happen. Bulls outnumbered bears last week by a little bit, but perhaps it was premature. As you can see, the previous periods back in 22, most recently when we first dipped where bears outnumbered bulls, it was just the beginning, and we had that whole midterm election year bear market that transpired. So keep an eye on the sentiment, and as maybe Barry and I'll touch on later, that contrary sentiment is really only helpful at extremes. So my full analysis and outlook was sent out to Almanac investors, newsletter subscribers in last night's issue. You can check that out at your leisure. But now I'll take this chart down, and we will bring on my man, Barry Ritholtz.
Hey there.
Hey, how you doing?
Pretty good.
Thanks for coming on, man.
I'm kind of calming down from a panic, having nothing to do with the market. I ran out before, and I'm like, I got plenty of time. I'll get back at 4. I'll see Jeff at 4:30. And I grabbed a keychain that didn't have a house key on it. And I started to freak out. I'm like, all right, take a breath. Who has a key? And I'm like, wait, we have a back door with a digital code. And for the life of me, I couldn't remember what the hell the code was. And eventually my wife figured it out. She's like, I don't never use that. That's for you. I'm like, I didn't set it. I don't know. So here I am, not panicked at all about the market, but annoyed that I walked out the door without my key.
Got to do the check all the pockets on the way out. Yeah.
No, I had that. I have the problem is it's a weird front door key. We only have so many copies, and all of my keys have this little hook. So I will occasionally, I have like 2 or 3 house keys for 8 or 10 keychains. And so I'm always just swapping the house key. And the one time I didn't look, there you go. Just stupid. But yes, always wallet, watch, keys, glasses, phone. That's my out the door routine.
Spectacles.
Yeah, I know that. I used to hear that. And because it rhymes, it has to be true.
That's right. Like history. Barry, I got to give you the proper intro. He's a co-founder of and chairman and chief investment officer of Ritholtz Wealth Management. Launched in 2013, RWM is now the fourth fastest growing RIA in America. Mazel tov. Congratulations.
Thanks. And that's with like practically no M&A. Most of the fast growing shops, they're just buying their way onto the list because they're, using private equity. That's almost all organic growth.
Some good people.
Yeah.
A lot of good people who I like, and some of them are friendly with. So
yeah, we have an eye for talent. We really do.
And fun, which, but in a intellectual, in a serious way. So I think you and I met over 20 years ago.
It's got to be at least 20 years ago. It was long before the financial crisis.
Not too long, about 5 years. I think Yale and my late father, came to visit you, or maybe it was just me at the Maxim offices or something.
Oh, geez. So yeah, that's
we had a little discussion. I think
I was with Maxim. I want to say August 2002 to December 2007, December 2006, something like that. So like a solid 5 or 6 years in the Chrysler building.
I looked at some old email and I see a record from 2003.
Wow. So well over 20 years.
Yeah, 22-ish, because we were having a discussion about contrary indicators.
That's right. I remember doing a piece about market bottoms.
And it was the end of that 2000.
October 2002, March 2003. I had flipped bullish, and it was great because every broker in the firm thought I was a lunatic. And look, how much more do you think the Nasdaq is going to go down? It's down 81%. If you haven't sold yet, it's kind of too late to sell if that's the sort of institutional trading you do. And if you have sold, what are you waiting for? How much cheaper is it going to get?
We had come in a little bit earlier using Yale's old playbook with the buy in October 2002. A little bit early.
Can I tell you something? Not time-wise, yes. Price-wise, no, because you had the October 2002, a little bit of rally, double bottom for the start of the war, March 2003, and that was it. You were straight up until October 2007. It's bizarre how vividly you remember those dates.
It was a nice trip for me going through the email, looking for when we first met. But
wow.
So ever since you came on the scene, man, you've been innovating and rewriting the investing landscape. Controversial yet honest and truthful about market and life. Your commentaries.
Really controversial? Is that so I push a little bit back on controversial, because if you're looking at the data and you're trying to think about things in a slightly outside of the box way, occasionally it will lead you to places that either the rest of the market hasn't gone or you just get there a little before them. And so I don't know if controversial is the right phrase.
You call people out on stuff.
Oh, well, okay. I'll plead guilty to that.
So,
but only those people who really deserve it.
Yeah, one of my favorites in the book, which I'm going to get to in a second. Your blog's one of the first, still one of the best. Your podcast was one of the original ones. When did you start that podcast?
Bloomberg recruited me. I was writing about finance for the Washington Post. By the way, these are side hustles. Finance is my actual job. And it was the summer of 2013. They were recruiting me, and you got a tour of the new Bloomberg facilities, which are amazing, still amazing, like a decade later. And hey, how do you feel about a daily television show? And I was like, no, I don't have something to say every day on TV. But what would you like to do? I'd like to have an adult conversation with somebody from finance each week who's intelligent and successful. And that was like the fall of 2013, and it took us about 6 months to kind of hammer out a bunch of things. And by July 2014, last summer was 10-year anniversary. We're about 500 and change into the show now, 500 episodes into the show. So yeah, 11 years ago.
Fantastic. Full disclosure, Barry wrote the foreword for my 2011, which was based upon my, go ahead.
I was going to say, it's a really good story because you published something about the super boom
In
and
May of 2010.
and I had been a stock trader almanac dedicatee one year for more or less getting the top and bottom of the GFC right. And so I did a post and it's like, I know Jeff Hirsch and this is a crazy forecast, but I'm fascinated by the analysis. And you reached out and said, let me walk you through the thinking. And you basically brought me around to the point where I dig this. I had written about it, and I updated that. I said, hey, if you ever do anything with this, I'm enthusiastic. I love the thought process here. And then you said, well, I'm going to write a book about it. And when I think that's the story I tell in the forward. Hey, I thought Jeff Hirsch had gone off, gone bonkers. And his explanation was so compelling that he brought me around.
As you say in your book, the new one, which I'm enjoying reading, I stood on the shoulders of a giant, my father.
For sure.
From the 70s.
Right. So, he basically late 70s, before the 82 breakout, before the Paul Volcker 1980-81 breaking the back of inflation. And he said, all these things are going to happen, and here's why. And it's the same fundamental premise. War plus post-war inflation equals stock market gains.
And we recently talked about, you had me on your show, your newer one, and we talked about, and you were really keying on how the COVID inflation was very similar, which is to the war inflation, the war spending, and which is something I had already gotten to. So it makes a lot of sense if you think about it.
For sure.
Much like a war footing, the whole COVID.
The most hate mail I've ever gotten for any piece I've written came out April 1st, 2020. And all it said was, don't assume COVID ended the secular bull market that really began in 2013. And just like furious hate mail. And the thinking was, hey, this is an externality. It has nothing to do with the market or anything like that, even though its after effects certainly impacted the economy and the markets. And, the economy was robust enough. It should have been able to withstand this sort of shock, plus a massive fiscal stimulus. And I didn't say, here's what's going to happen. I just said, hey, everybody's talking about this bull market like it's over. Mm-hmm. This is when the meteor killed the dinosaurs, the meteor that came out of space. Hey, the next species time was up, and that was the mammals got to step in. So when an externality rocks the market, hey, you know what? It's not going to be local. It's going to be the big global international tech companies. And you had a giant run that followed it. But goddamn, like I got such hate mail. It was really a blast. It's fun reading them because it's all people's emotionality. You can't, just because I don't get upset if I get an email calling me an asshole. This is the dumbest thing I've ever read. You're an asshole. It's like, wow, how you have to look at it as a reveal. It's like, oh, this person is definitely leaning the wrong way into this market, and they're very emotional about it, which isn't helping their trading performance. And, I have this duality. I started on a trading desk. So I'm always looking at things. Hey, what's going on short term? But we are long-term investors on behalf of our clients, $5-point-something billion. So we always want to look out into the future, not get stuck, in minute-to-minute trading. You have to know what your timeline is.
You got to know yourself. So let's talk about the book. How's the book tour going?
A lot of fun. I'm talking to a lot of people. I'm seeing people and catching up with people that, some people I know and only get to see occasionally. Liz Ann Saunders of Schwab We got to reminisce. The very first TV show I ever did was in a tiny little studio. It was Larry Kudlow, Liz Ann Saunders, and I just talking about markets for an hour, and it was so much fun. But I'm having a blast, and it's what's interesting is the difference between the last book, which was 15 years ago, and this book is the world is so different. Like 15 years. So back then,
better at writing.
yeah, well, I started in the late 90s. So this is the writing part is easy. It's now go out and promote it. So back then, people wanted reviews in major newspapers. They wanted to get on whatever television show promoted it. And now the approach is how many financial podcasts does anyone listen to? 1, 2, 3. All right, you do a million. They're all a different. Nick Majuli reverse engineered the bestsellers list, and he said, if you every podcast is its own discrete audience. So rather than broadcasting wide, if you get a review in the Wall Street Journal or the New York Times, it's got millions of readers. You have to reach those millions of readers by doing them a few thousand podcast listeners at a time. And I think he's absolutely right.
Yeah, that's why we're doing this. So the book's fantastic. I'm reading it. I was hoping to have finished it. Conceivably, I could have before our meeting here, but it's so good.
Yeah.
That I'm stopping to highlight and underline. It's making me think of stuff from the past, from the Almanac. So a testament to that. I will get through the whole thing. Maybe when I'm done, we'll get together again and have a chat.
Sure, happy to.
Or over over some coffees or whatever.
Coffee.
So
we'll have coffee talk.
We'll talk. So
No
quote the talking heads, since we're both big music fans.
Right.
How did you get here? There's a series of steps from failure to failure. What were those key steps for you? How did you get here?
So I said I started on a trading desk, and I was really quite fascinated, less by my own personal P&L, which swung wildly from month to month, and more on how come the guys on either side of me were so consistently inconsistent. How come this guy's killing it this week or this month, and the guy on the other side is getting demolished, and then the next month they like reverse roles, and this guy can't trade his way out of a paper bag, and the other guy, whatever he touches turns to gold. And it sent me down the rabbit hole. The first couple of books I had read about investing, one was Jack Schwager's Market Wizards, which really is it's really a thinly disguised risk management and behavioral finance book, because it's not about stocks or bonds or currencies or futures or anything else. It's all about
book of the
right.
year.
But it's all about how you manage yourself, how you develop a process, how you think about risk. So that was like one of those eye-opening books, like, oh, everything else I've read about finance and investing in markets are about the assets. They're about the trade, not about the trader. And Schwager was the guy in the seat. Whoever's in the seat is what matters, not what they're trading. So that was eye-opening. And I don't know how I stumbled across Thomas Gilovich of Cornell University's How We Know What Isn't So. Just this, the first 2/3 of it is pretty much the first popular behavioral finance book, the first behavioral economics book in popular print. Mm-hmm. And that, just sent me down the rabbit hole. You discover Kahneman and Tversky, and you discover Schiller, and you discover Thaler. And then when Kahneman and Tversky, or actually Kahneman, because Tversky had passed, won the Nobel Prize, it's like, oh, I'm kind of on the right track here, isn't it? It was really helpful to think about, what do we know? What don't we know? What do we think we know that isn't true? How does this affect our decision-making process? Really the book is ostensibly about investing, but in reality, it's about epistemology and decision-making.
It's almost a self-help book at some level.
Right. I love this.
It's about being, thoughtful about yourself.
Right. be a little less gullible and naive, be a little more critical in your thinking. Don't just assume that the used car salesman trying to get you to buy this SPAC or that fund has your best interest at heart. Like, look at people's motivations. Sometimes you got to think like a trial lawyer cross-examining a witness. Sometimes you got to think about like markets like a historian or an accountant or a psychologist. You're constantly, I love the metaphor of the six blind men describing the elephant, and they're each describing something differently because you're at the tusk, the tail, the ear, the leg. It's very different. And the market is the same way. You get all these different hot takes on the market, but really what you're involved in, what asset class, who your clients are, what your time horizon is, what your risk tolerance is, all those create this prism, and it affects how you view the world. And when we see these people often on TV arguing, I'm gesturing to the TV, arguing about whatever's going on in the markets. Like, I always used to hate when I get the phone call.
It's just to sell ads, so they
That's
can keep
just
people.
right. It's to create this. It's reality TV. It's to create this artificial tension. I remember right after the financial crisis, we had flipped bullish, very fortuitously timed. I went on Yahoo Finance the day before the bottom. You could have asked me the same question a month early, a month later. I would have given you the same answer. It was dumb luck. I got back from vacation. I had told a buddy after the Dow 6800 discussion, which was really, hey, if Reinhardt and Rogart are right and a leverage-based crisis leads to housing falling 30%, they put out this little 5 crisis paper, Japan, US, Mexico, Sweden. I never remember the fifth. It always escapes me. And real estate falls 30%. What does that mean for the Dow? And I kind of reverse engineer it, and I come up with 6,800 when the Dow was like almost 14. So no one wants to talk about the analysis. They're just freaked out by the number. And so I said to a buddy, we get anywhere near 6,800, kick my ass and make sure I cover my shorts. And so
below, right?
That's I was on vacation when we crossed 6,800. I got back. My wife was a teacher, so we whatever the school vacation was that March, and I got back, and that Sunday I get there's the phone call. Hey, I know you're away, but 6,800, we're below it now. What are you doing? I'm literally, I'm typing up my notes right now. And so I shoot it out Sunday night, and I immediately get a phone call from Blodgett. Hey, you want to come on Yahoo Finance TV and talk about this? Sure. And he had me on when the piece first came out. And it's a tragedy that Yahoo's series of updates lost all those comments, because the Dow 6,800 discussion in October 07 was, this guy's an idiot. He's a perma bear. He doesn't know what he's talking about. And then the same conversation in March 09. This guy's an idiot. He's a perma bull. He doesn't. And it's just so revealing.
It sounds like that joke about the Mexican fisherman who has they come down and tell him to start a whole industry so you can relax and go to the cantina with the boys. And he's already doing that.
Right. I work 2 hours a day. I bring home a few fish. Why do I need to manage people? That's been, by the way, trading desks used to get the funniest jokes circulated all the time. And it was always gallows humor when the market was getting shellacked. But basically, I know I'm wildly off topic from your original question.
Well, let me bring you back in. So in the book, I'm told you how much I'm absorbing a lot of it. So you start off with avoiding errors. This is counterintuitive. Avoiding errors is more important than scoring wins. I have a quote of yours in the Almanac. I think I just edited the beginning of it, where it was from your blog in 2010. People have difficulty cutting losses, admitting an error, and moving on. I'm rather frequently and on occasion quite spectacularly wrong. However, if we expect to be wrong, then there should be no ego tied up admitting the error, honoring the stop loss, selling the loser, and preserving your capital. One of the longer quotes I allow because it's so juicy.
It is juicy, isn't that? It kind of goes to the aspect that, finance and Wall Street should have more humility, should be humble. And as the book shows, they have a lot to be humble about. When you look at economists and strategists and fund managers, even the wildly successful ones, they really should stick to doing what they do best, which is managing their money, and stop making these ridiculous forecasts, which not only do they tend to be wrong, but viewers or listeners tend to believe them. And so, one of the first chapters is about Sam Zell, a legendary distressed real estate investor.
Starts making market, starts calling it the recession or the
right. And so the few times he called a recession, there was no recession for 5 years. In fact, his last recession call was 2015. I don't think in 2015 he was saying, hey, there's going to be a global pandemic that'll cause an economic contraction. And then there have been a few before that were wrong. My favorite is Leighton, or in the middle of 08, he goes, I don't think we're going to really see a recession or a balance sheet problem for real estate. Dude, we're 9 months into a recession. And I love the stealing from Arrested Development narrator. There were going to be a balance sheet problem for real estate. He says, real estate balance sheets are fine. Narrator, they were not.
One of your lines, every market gives us an opportunity to learn new lessons. You will find that the tuition much less expensive if you can learn from other people's mistakes rather than your own. It reminded me of one of my favorite longstanding Almanac pages in the back of the book from Yale. If you don't profit from your investment mistakes, somebody else will. We've got a little table where you can track your recommendations. Ritholtz said, buy this stock on this date. My son came into me years when the GameStop meme thing was going on initially, and it was AMC also. He tells me about AMC. I remember teaching him, okay, Sam, you got to put it down right here and see why you wrote, why, what the reason is.
Give your explanation, create a trading journal, 100%. Right. So
another thing that, I'm very tired, as you are, of everybody on TV, all the talking heads. They're always saying, I think this, I think that.
I believe, I think, well, I feel. I love, I feel. Oh, really?
I believe is a buzzword to sort of, instead of saying I think, but as you tell everyone what the real 3 most important words are.
I don't know. And there's a reason for that, because I'm fascinated by being in a room with a bunch of smart people, and one person is talking fast and using concepts you're not familiar with, or saying something it doesn't quite make sense. I don't know if I think this story ended up on the cutting room floor, but I remember doesn't matter. Like 03, 04, I get invited to hear a pitch from a bunch of guys from a big house talking about, we could get you 300 basis points more than risk-free treasuries at the same level of risk, not an increase in risk. And, they do their presentation. Any questions? And I raise my hand. Hey, could you repeat that thing you said in the beginning?
I just threw the bullshit flag.
Yeah. Which is, I couldn't say that in front of the room. So what I said was, either you guys are going to win a Nobel Prize or someone's ass is getting thrown in jail. There's nothing in between. Either you guys have figured out how to create reward with no additional risk, or something is a little fishy. And that firm was Lehman Brothers. And there was a little uncomfortable giggling when I said it. I did get called into the general counsel's office the next morning. What are you doing? We're trying to do more business with these guys. Not if they're selling shit products that's going to blow up in our face. You think you know more than them? And as it turned out, in that particular instance, the correct answer was yes, you can't get more returns for the same level of risk. Returns are a function of assumed risk. They're two sides of the same coin. There's a lot of other factors. We end up learning about all sorts of different things that happen that we occasionally overlook. There's this concept called the Peltzman effect. He was an economist who was looking at all of the regulations for seatbelts and eventually airbags and crumple zones and ABS. And as all these regulations came in, we really didn't see a giant decrease, an immediate decrease in drop in fatalities on the road with all these automotive safeties. And the Peltzman effect is when we become more comfortable with a certain level of risk. Well, that's our level. And it's like, the risk level is dropped. So what we do is we step on the accelerator, we're driving faster, and we're back to our prior level of risk. And so you see that happening in the markets. Hey, trading is free. Expense ratios have come way down. Cost structure is much, much lower than it used to be. Yeah, but I'm used to this much risk. So maybe I'll trade a little more. Maybe I'll stock pick a little more. Maybe I'll do this. And it has a pernicious effect on returns.
Mm-hmm. So it's similar to me. I make the analogy with football, NFL football, and rugby. There's no pads in rugby, so the collisions are much more controlled, and the impact is much different. You don't see as much of the CTE stuff and of the craziness that goes on when you put on all that. I remember when I was 12 years old and I went out from Pop Warner football. I remember showing off to my mom. I got armor on. I can run it in through walls. So it's similar, when you put on more safety measures. So
yeah, no, it's absolutely a real thing. I want
to thank you for addressing Dow 36,000 in your book. I don't know if you remember. I addressed it in my Super Boom book. I made this wild forecast that we discussed earlier.
Hey, eventually these guys are going to be right 25 years later.
You dubbed it the most spectacularly wrong investment book ever. So
it is. It really is. Its whole underlying premise is nonsense. The 36,000 came about by saying, let's take the 7 previous years and just extrapolate forward 7 years. No context. No context, no framing. It's like, hey, aren't you aware that the past 7 years have been, from 93 to 2000? I think that book came out fall of 99. Yeah. That's one of the best 7-year runs we've ever seen. Why would you imagine?
At the top.
Yeah, like, wait, you think you can get another seven more years of this? It was just, but the underlying argument was also terrible. Stocks are cheap up here. We measure valuation wrong.
Numbers.
Yeah, it was just wrong on so many levels. By the way, I think one of them, not Glassman, the other one, is a member of this administration, which is like, I would have thought that book meant that go to dental school. You're done in this field.
He is now Trump's director of the National Economic Council. He was in the previous administration also. I've seen him recently.
Are you blaming him for this market sell-off? Is that what you're saying here, Jeff Hirsch? No. Are you saying that the author of Dow 36,000 is why this market is in the shitter? I hadn't really thought about that, but now that you brought it up, Hassett's going to send a bunch of mass men to your house, and your green card's going to be revoked.
I pull out my fillet of his book in the Super Boom, which we did many years ago. I was just wondering what you thought of him being in that position, being the author of the most spectacularly wrong investment book ever, and now he's directing the National Economic Council.
Well, I don't want to get political or partisan. The obvious joke is the author of Dow. Today's market volatility brought to you by the authors of Dow 36,000. No, I think that, there's a little bit of a Peter principle. People just keep failing upwards. Everybody has their crew, and sometimes you're not objective in evaluating who they are and what they do. So I would have assumed that book was the kiss of death. But as I explain in some of the later chapters on why you should never mix politics with investing, and why when you see these partisan political people on the left and the right, and when you see investors behave in a partisan way, it never works out. And so this is kind of a reveal that he's not really a market strategist. This was a partisan screed.
So maybe his economic strategies, okay?
Say that again?
Maybe his economic strategies are okay.
I don't know. I think that he was hired not for his back to some of the other things we said earlier with Sam Zell and his economic forecasting. The most generous way I could describe it is he was hired for his economic policy wonkery, not for his market forecasting ability. So I think that's a kind way to describe that.
Fair enough. So you brought up politics. Politics and investing, you said in the book, make for terrible bedfellows.
Terrible.
What about one of the Almanac's features, the 4-year cycle?
So I'm a fan of looking at the market from the framework of long-term and short-term cycles. And we clearly understand the impact of momentum as a factor in market returns. So when you stop to think about it, especially if, starting with Yale and now with you, the original framework for the 4-year presidential cycle was, and you do a better job describing it than I do, but hey, year one, here's a bunch of things that are going to come out, but the bad stuff comes out early, and the goal is to either retain the House and Senate or get reelected. So here's what's likely to happen in year 2, and then year 3, maybe you don't control the Congress anymore, so you're going to do all this foreign policy stuff, and then here's what the reelection cycle looks like in year 4. And so you can use those as really broad guideposts to, hey, did we get this? Did we see this tax cut? Did we see this fiscal spend? Okay, here's what this has meant historically. Having that rough outline is enormously helpful. Even if I'm not trading day to day or month to month, I'm looking through the cycle to the other side. That's how we manage money, because our clients look, everybody always asks about volatility. If you're retiring in the next 6 months, 18 months, 36 months, you have every right to be concerned about this, because there's a sequence of returns problem. You don't want to start your first year or two down 10, 20%. On the one hand. On the other hand, if you're just had a baby and you're maxing out a 529 for your kid's college fund, hey, that's 17 years from now. You don't have to worry about this administration. You have to look through it. You're retiring in 20 years and 15 years. What happened?
What do you do for somebody who's retiring, like one of your clients who's retiring without having this market sell-off happening right now? Like, how do you prepare a client?
You slowly shift away from equities, away from an equity-heavy portfolio to something a little more balanced. So maybe you go 70-30, 60-40, 50-50. Over time, this doesn't happen immediately. And, the challenge, look, when Social Security was formed about almost a century ago, you would retire at 65, play a couple of rounds of golf, and drop dead at 68. That was the average lifespan. Today, you make it to 65, you got a solid shot at 80, 85, 90. And so the concern is, how do I not outlive my money? And so if we're tacking on an extra 10, 15, 20 years of longevity, well, then I think you really have to stay with equities longer.
It's not the Phil Pearlman show. We're not going to get into health span and longevity.
No, not that. But recent conversation with clients, guys thinking about retiring. He's mid 60s. His parents, who are mid 90s, are both still around. And it's like, dude, you have amazing genes. You're very healthy. It's early for you to move to all bonds, because you're going to need this money for another 30 years. And even with this volatility, I think you're going to want to have more than a minor set of exposure to equity from here forward. I think you really need to have, at the very least, a 50-50 portfolio. But you have to think of this. It's not like you're 65 and retiring at 68. you have to think of this like you're 50-ish and you're retiring at 68, because you're gonna, even if you're not working, you still need this portfolio to throw off 4 or so% a year for another 20, 25, 30 years. That's a long time.
One of the things you talked about in the book was knowing what the people are selling who are saying what they're saying, who are prognosticating. You've given a lot to the world of investing very freely. You've been candid about what you're selling, wealth management. We were just talking about it. In the book, you expose some fallacious track records and highlighted some spectacular ones.
Yeah.
What are some of the best and worst, some ones that stand out? I mean, I know you've got your all-star team that you refer to, some people you mentioned. Like, who's got these records that that you can rely? I mean, we lost Art Cashin this year.
Right. He was on my list. The manuscript went in before we unfortunately lost him.
He was
one of my favorite people in the world.
He was great, and I think it was Pisani's book party. I don't think were you there? I know Josh.
No, I was not at Pisani's book
Josh
party.
Came up to me. He was at the New York Stock Exchange, and Art was there. Josh came up to me. I was chatting with, I don't know, somebody, Santoli or something. He's like, Jeff, go talk to Art. He might not have a chance for a while. So I went over and I spent some time, and I got to thank your partner. Your
I used to go to the Bobby Vans across the street from the New York Stock Exchange, and we would marinate some ice cubes. But I had a buddy, Mark Lehman, who was out of Switzerland but working in New York, and he was very senior in the UBS investment committee. And early, like before 08, 09, he said, hey, I have a friend who's in the next town from me, and he makes a pretty compelling case that the risk factors that are out there are a whole lot higher than Wall Street has recognized. Would you like to chat with him? And so we had a conversation, and Art said, hey, would you like to speak to our brokers? I'm like, which ones? Like, all of them. Sure, Art. So I did the morning call. I want to say was sometime in the fall of 07. And I just laid out the history of finance is based on of lending is based on the borrower's ability to service the debt. And once that changed to the lender's ability to sell it to a securitizer, well, then all bets are off. And that's why you've had all these spikes. And here's the historic relationship between GDP and the value of residential real estate, and it goes straight up. And here's the cost of renting to cost of ownership. And here's, like, I show him and here's median income to median home price. And in every case, the price of housing was just orders of magnitude, like 3, 4, 5 standard deviations away from historical norms. And to Art, he told me afterwards, he goes, that was really good. We got a bunch of pushback, but we'll have you back some other time. After the financial crisis, I went back and did it again. And this time, everybody stayed on the call. There were a lot of really thoughtful questions, and nobody was thinking of me as kind of a jackass, which I suspect is what happens. In a bull market, nobody wants to hear the guy warning about risk. They just don't. So when we did the big picture conference, which started in like 09 or 10, and I'm like, I got to get Art here. Art, like, you could hear a pin drop in the room. He was telling stories, and they're just amazing. And everybody just hung.
One in October of 2011, and there was a bottom there, and somebody said, "Who's the bull?" I think it was Aaron Task was moderating it. He said, "Who are there any bulls in the crowd?" And I was in the back.
One hand goes up. I love that.
A couple other guys, but it was one of those nice contrary sentiment indicators there. Anecdotal.
So you mentioned sentiment earlier. You and I have both talked about, look, what people don't understand about sentiment is that the crowd is the market.
I've got your quote, man. I've got your quote.
Go ahead. What is it?
The Almanac. It's from Bloomberg View in 2013, December. The death of contrarians has been greatly exaggerated. The reason is that the crowd is the market for most of the cycle. You cannot be contrarian all the time. Otherwise, you end up simply fighting the tape the whole way up or down, therefore being wildly wrong.
I mean, that sounds like common sense, doesn't it?
Yeah.
I mean, it's and so what you want to do is identify when the crowd of soccer fans turn into out of control hooligans, flipping over cars and lighting shit on fire. That's when you say, I need to be on the opposite side of the stadium from those people, but also the opposite side of the trade. Because when people run amok, you just don't want to, that's just, pure limbic system mania. And it's just absolutely, we're not chasing P&L, we're chasing a dopamine rush. And that's no way to invest in the stock market.
Lot more going on in the book here. A couple other things. You have some great words in there. Some great vocab. Metacognition, one that jumped out at me. There's a bunch of others. What's
epistemic trespass? I love that phrase. Epistemic trespass.
Yeah, there's a whole bunch of good ones in there.
Quick funny story.
Go ahead.
Quick funny story. So I read the audio version of the book, and first of all, reading a book out loud teaches you a couple of things. First, it teaches you don't know how to speak words good. You don't. It's like shocking. Me speak good. It's shocking that first of all, as a New Yorker, you tend to speak fast, and your brain is faster than your tongue. So first, you have to learn to slow down and speak a little slowly and quietly. But secondly, you learn how hard it is to, like, you drop S's and you transpose syllables and you mumble, and like as a New Yorker, a lot of R's disappear and a lot of G's go away. Hey, I'm walking here. It's like, so just
I spoke to Barry a couple times. I like.
So, but the craziest part is discovering that these words that you have been writing and reading your whole life, you don't know how to pronounce. Epistemic trespass, or epistemology, or I couldn't get past capitalization. Because when you're reading fast and you say in the market capitalization, and then the engineer is, can you repeat that word? You just kind of slurred the middle three syllables. It's market capitalization. It's so it has to be pristine. Like, plus, anytime you touch your clothes or your stomach gurgles, or you can't even have milk in your coffee because your lips start to smack. So you learn that I barely know how to read. I don't know how to speak out loud. And half my vocabulary I don't know how to pronounce.
All right. So back in the old days, we had a sign on Yale's office door, an award we gave him called the Walking on Water Indicator. You make a key point, or you make this point a lot in the book, about recognizing how little you know is a superpower.
Right.
If we were less certain of ourselves and had more humility, we would all be better investors. So how do you keep your emotions in check, your ego in check? How do you hone that humility? Because, pride goeth before the fall, et cetera, so forth.
So a lot of it is, some of it is just a self-check. Some of it is just, what do I know? What don't I know? You shouldn't answer questions just because someone asks it. Or at least if you're on TV, I think this is a leftover effect of America's educational system's emphasis on testing. Like, we think that because someone asks a question, we're obligated to answer it. So when someone, I love saying to anchors, so where do you think NVIDIA's stock is going to go?
I don't know.
Dude, how the fuck should I know? I'm not an NVIDIA analyst. It's all over. Where's Bitcoin going to be? Over there. I don't know where its price is going to be. How on earth should I know? Bitcoin could be 200,000. It could be zero. I give you the same odds on either.
What's the trick to keep yourself in check? Take a breath. Constantly.
So two things, like an internal measure and an external measure. The external measure is you just have to be present and thoughtful and aware that when someone asks you a question outside, and you see me, I'm just adrenaline and caffeine and more, whatever it's like batting practice. Just whatever you're throwing at me, I'm swinging at. But you have to recognize that. And when someone asks you a question, I had this conversation with a group of clients like a year or two ago, and they said, "So, what's your opinion on this?" Was at some event. What's your opinion on, COVID? Was it a wet lab? I'm sorry, was it a wet market that trans species, or was
Or was
this, created in a lab? And I'm like, let me ask you
Yeah.
a question. To answer that question intelligently, I would need to have a whole lot more expertise in epidemiology, virology, interspecies transmission of viruses, to say nothing
Science in
of
general.
my NSA clearance is much lower. I don't have top secret access.
I mean, you
I'm
have a law
allowed,
degree, not a biology degree.
right. And it's like, but you're asking me questions that people who are experts in the space can't answer, and that people who are experts in national security still don't know. But the bigger question is, why do you feel compelled to have an opinion on that? It's not necessary for anything. Warren Buffett gave people some really good advice, and most of them, unfortunately, don't listen to him, which is surprising because I think he's done okay for himself and he's put together a pretty good track record, right? Buffett said the difference between investing and baseball is investing, you can stand there with your bat on your shoulder and you don't have to swing at every pitch. You could wait for your pitch. Right. So when someone asks you what's your opinion of whether or not this is a trans species jump or a weaponized virus that escaped the lab, it's like, I am not obligated to weigh in on that. And if I'm half intelligent, I will say, don't know, don't care, not my space. I hate when people say stay in your lane, because I think of my lane as pretty broad. I have researched and spent a lot of time reading and writing about a pretty wide array. I think the book reveals a lot of different things interest me.
Deep research, some great references in there.
But it's not everything. When someone asks you something that's way outside of your skill set, you could say, don't know, and don't have to have an opinion. And it doesn't really matter whether this was caused by a lab leak or a wet market. What does that have to do with corporate revenues and earnings outside of a tiny sliver of defense stocks? I mean, okay, so there are people working on biotech warnings and terrorist alerts. And, you look at Palantir and you look at some of these other companies, and it's like, okay, that's a teeny handful of the market. But, but for the analyst that covers that, I don't need to know that.
So let's talk about your deep work, your process.
Okay.
What, it struck a chord with me. I find I can't sit still and meditate. We're kind of got spielkes, as my grandmother used to say,
Right.
So
you and I are both from the ADHD generation. So
I find walking, hiking, I now, thank God we have this phone thing with the voice memo. I have ideas. I hit it as I'm going up the hill or around whatever, and I'm talking to myself. I made notes for our call, just randomly, so that's where I do a lot of deep work on the move.
Mm-hmm. So I'm kind of similar in that, I love the waking up early in the morning. I never use an alarm clock. And every time you go to sleep, it's like your brain etches sketches. That's a reference that a lot of people won't get, but it's a fresh reboot and you start clean. And very often you sit down at the computer and ideas just flow. What's that?
Nobody knows what an etch-a-sketch is anymore?
Not if you're under 25, 30. I don't know if they know what an etch-a-sketch is, but I'm sure there's an etch-a-sketch app somewhere that
you reset.
Yeah, you reset. You get to sit down, and Michael Batnick in my office is always like, "How come every time I text you, it says Barry is unavailable?" I go, "Do you get a text back right away?" He's like, "Yeah, because I don't want the alert." I wear a bunch of watches, but never an Apple Watch, because I appreciate the mechanical beauty of how traditional watches are put together. I don't I don't want to be beeped every time there's a Slack or an email or a text and I find that if
Yep.
I block off 2, 3, 4 hours in the morning, that's 90% of the work I do that day. And then by the time we come around to, I don't know, 10 o'clock, like the rest of the day is meetings and calls
10
and
a.m.
bullshit. 10,
Yeah.
11 a.m. is, I
Yeah.
feel like the vast majority of my, so that being able to work in a non-distracted way, I think, and you have to realize there are switching costs. There's a cognitive load and a switching cost for people who jump from reading to text to checking Twitter or checking social media to, like, your brain has to stop what it's doing, cycle
Transition.
down,
Yeah.
move to the next thing, and then ramp up. I'm not an expert in that space, but
No.
I've read a bunch about it. And what I have read is pretty compelling that you're much better off. I'm going to do this for 2 hours. I'm going to do this for a half hour. I use my little kitchen timers, and I start working on something, and I'm going to say, I'm going to do this till I'm finished or till an hour goes by, and then I'm going to put it aside. Get up, go for a walk, have a cup of coffee, do some more stuff. I think the sort of random twitch response to every stimulus, it's exhausting and it's really super inefficient. I want to be like, I don't care about anybody else's morning routine. You have to develop your own. But I've learned that deep work is really valuable. And there's no such thing as multitasking. If you're multitasking, all you're really doing is 6 things half-assed. Do one thing, do it well,
Yeah.
move on.
So that's why, this whole deep work thing is kind of why I feel this book is more than just about investing. It's kind of a life skills book, I think, from my view. I feel like I want to give this, I'm going to give this to both my sons. I have a 17-year-old and a 19-year-old. I get a lot of Dale Carnegie, Napoleon Hill type vibe, but less bullshit, more down to earth.
I'm so glad you said that. I'm thrilled to hear that, because every time someone gives me a book that's like The Alchemist or Richest Man in Babylon, I always feel like they're just so ephemeral and they kind of cheat. I wanted to show the stories, the data, the real stuff. And, I want to lead the reader to drawing some conclusions that are supported by the academic research and the data.
And for the younger folks out there, there's a few vernacular words that come on. It's bussin', it's lit, it's fire,
Right.
no cat. It's what
Okay.
I was trying not to be a boomer about it, but maybe
Right.
going there makes
You're
me
really not, like, you and I are really not boomers. We live in the valley between the boomers and the Gen
yeah,
X.
yeah.
And if you just, so now let me bring some data analytics to this. So what is a baby boom? A baby boom is when a whole bunch of people return from war, for example, in 1940, let's
5.
call it 5, the end of World War II, and 15 million GIs return home and they haven't seen
18
their
years later.
wives or girlfriends for 3 years. And, 9 months later, there are a lot of newborn babies. And that continued for 1 year, 2 year, 3 years. So it continued for the rest of the 40s. It continued for the 50s. I think by the time you're in the mid to late 50s, early 60s, the post-war baby boom is over. And now you're back to normal demographic. And you could see that when you see the bell curve of,
54 is the cutoff.
yeah, which is total bullshit to me. I think 59 is the cutoff. And like, I know my sister is truly a Gen Xer, and her likes, dislikes, tastes, and the boomers likes, dislikes, taste. You and I have a foot in each camp, but
Yeah.
we're not truly boomers the way the people born in the 40s and 50s were.
No, not at all.
And from a contrarian point of view, being in that valley between the boomers and the Gen X allows you to see stuff from outside of that group prism. It's like a small group that, hey, we're nomads. We're not necessarily a member of any tribe or both tribes or neither tribe, but it gives you hopefully gives you a slight perspective.
What's your first current event, real, big current event memory?
I remember I said it was Kennedy's funeral. JFK. My mom says it was RFK, but RFK was later, what was much later. I
68.
Yeah, I kind of remember the horse-drawn wagon for um John Kennedy, but I would
Well,
be
you were
like
born in what,
teeny
60
tiny,
or 61?
61.
Yeah.
So she's probably right that it was, I was a 7-year-old. But I have recollections of an apartment that we moved out of in like 64. So
Yeah.
so looking out the window, looking at a tree across the courtyard and not understanding why one tree didn't blossom when all the other trees did. And my dad telling me that tree is dead. The other trees are going to keep. And I'm like, and
My,
I said to him, good thing that we're not trees and people don't die. Trees die. And my dad said, well, I got some bad news for you, boy. Everything dies. And that was like,
so just to put a date on it, to let you know where my head is, my first real memory is Watergate.
right. You were born so you're really a Gen Xer then. You're
66.
born when?
66.
So you're like a year younger or so than my sister. So you're like dead center in the Gen X group.
But I had two Beatles records come out that year.
Right. That's
Rubber,
right. You
Rubber
had
Soul.
Rubber Soul and Revolver.
Big stuff.
And then the next year was Sgt. Pepper's, and then the White Album. And then, and in the book, since you brought up the Beatles, in the book, just to show you how little people know about what's going, forget the future. Nobody knows what's happening right now. So I love the story about Ed Sullivan turning the Beatles down multiple times, a couple of times, and then coming back from London Airport, now known as Heathrow Airport. And by dumb coincidence, when he goes to the airport, the Beatles are coming back from, I don't remember if it was Stockholm or Helsinki or somewhere, but there's 10,000 screaming teenage girls there. And you don't have to be a music impresario, another word I don't know how to pronounce,
Impresario.
to recognize, oh, something's going on here. We should book the lads. So he gets back to New York and says, okay, let's bring them on. And up to that point, despite the fact that they were number one in the UK, that at one point in time, I think they had the top 5. They were 1, 2, 3, 4, 5. Like, just the numbers are insane. EMI and Capital, sister companies. EMI is in the UK, calls Capital. Hey, these guys are tearing up the charts here. You should release Beatles singles. They refused. Guitar Music is on the way out, they said in 1963. And there's just no reason for this. And to their credit, or to good corporate opportunism, when the Beatles were booked on the Ed Sullivan Show in 1964, and at the time, Ed Sullivan was like one of the biggest TV shows for breaking acts on television. Capitol released a couple of singles just to capitalize on the short-term pop from the Ed Sullivan appearance. Now, when Elvis Presley, another giant act, was on in the 50s, they got like 7,000 ticket requests. When the Beatles were announced, they got 60,000 requests. It was like order of magnitude more. And of course, they release the records, and immediately sells 1 million copies. The next one, 1 million copies. And then the Beatles come and they do, I think, 3 or 4 songs that night. And the reviews are uniformly terrible. I mean, some are better than others, but they're like professional music critics. The New York Times, the Washington Post, the LA Times, the New York Sun, like Rolling Stone, go through all of these. They're all awful. I don't think there was a Rolling Stone review in the book, although there were some terrible Rolling Stone reviews.
I was reading the book. You mentioned the word fallacious argument. I mentioned that word earlier, and it reminded me. I showed this to my son, who's an avid classic rocker guitar player, and I remembered this interview with Mick Jagger after he got released from being drug charges, for possessing amphetamines or something like that. And he has this press conference, and he goes by helicopter to have this sit down with the priest and the Jesuit guy, and they're talking about the laws giving people freedom, and he says that's a fallacious argument, and it stuck with me. And reading your book, I'm going up on YouTube, and I'm saying, Nate, you got to check this out, because it's like back then he was so on top of it, almost the same, like you used to call yourself the director of cognitive dissonance. That was one of your monikers.
Mick, by the way, very famously called the Beatles a four-headed monster, because every one of them really contributed to the band. Like, I think at the time, I don't think we realized what an inventive, clever drummer Ringo was.
Yeah.
And the competition, like the motivation, the one-upping each other between Lennon and McCartney, really. By the way, you don't have to be a Beatle fan. Right.
Beach Boys too.
And that's to say nothing about George Harrison, who put out some amazing songs, especially in the back half of the catalog. They forced him to be a better songwriter, because to get on the record, it had to be really good. Like even a crappy Lennon McCartney song is still better than 90% of everything else that was around. So the takeaway was, all the critics, all the reviewers, or at least most of them, they couldn't see what was right in front of them. It was groundbreaking. It was innovative. It was changing things, and they just were kind of set in their ways. All experts are experts in the way the world used to be, is the Paul Graham quote. And that's true for music. It's true for markets. It's
amazing the ground you've covered that I've read so far in just the first quarter of the book. We could talk forever. I'm hoping we'll have an opportunity to talk more about this work.
Love to.
One of my favorite memories of me and you is bumping into you at Jones Beach at Steely Dan. I think that was,
oh my God,
was that 06?
I can't tell you.
Go to the men's room or the concession or something, and like the same place. And now you've built this future-proof thing, which, I mean, I'm hoping to be at the next one. I've been
Matt Middleton is the genius who really is the guy.
Josh and you guys. So a couple of years ago, 23, you and I are standing there at the end when they had it was just this. Here we are.
Who was the band in 23? The guy who used to play with Jack Johnson.
Reggae cover band you had.
Yeah. I'm trying to remember his name. They were good.
Method Man and I think so.
Redman and Method Man. Right. Yeah. Who said some stuff that got us into a little bit of trouble.
Hey, if you ain't popping, you don't have if you don't have haters, you ain't popping, right?
That's right. So yeah, in fact, I can't tell you what year Steely Dan was, because they used to come to the Beacon and play a different album every night, and I would go to like half a dozen shows. The reason
I was able to find it using the power of the Google was because Michael McDonald was with them.
Well, he played on a lot of their songs,
right? But he was at that.
I remember that
he warmed up, and then he came back
right.
Them. I think that was the first time that it happened in a long time. So I think it was 06, which would align with the timeline of us getting together in 03 when you were Maxim. So anyway,
there was on YouTube a sort of documentary about Michael McDonald's career and how he ended up in the Doobie Brothers and Steely Dan, and how crazy it was.
The Yacht Rock documentary.
And then I had dinner with, it's Batnick's birthday, so me, Josh, Chris, and Michael went out to see Glenn Ross last night and go to dinner. And they were talking about that, and I'm like, first of all, I don't really think Steely Dan is a yacht rock band, and they're like, no, we know you're gonna love this, go watch this. So I just added that to my queue.
I took Evolution to Jazz and Rock in college.
Oh, really?
Yes. Our professor was a real jazz DJ, like a Jazz 88 type of DJ down in DC, and he said we could either do a recording of music and talk about it, or write a paper. I was doing a radio show. We did a reggae radio show down there on the campus of the school station. I did a Steely Dan radio show. I got
really?
A B+, me talking about reading the liner notes.
So last thought about humility. You asked me the question, how do you know, how do you check yourself? Big early Steely Dan fan. And then before I really knew much about the band's background, today you learn so much more than you could back then. When Asia came out, my initial response is, man, this is so slick. And then it was inescapable on the radio. There's just no getting away from it. Did these guys sell out? And then the next album came out, and I remember listening to Babylon Sister, and I'm like,
Take it.
I gotta go back and re-listen to Asia. And then suddenly you realize, oh, that initial response in hindsight was me. Like, I can imagine what the guys who were panning, Sergeant Pepper and Abbey Road. It's very hard to get out of the moment and see the bigger picture, to see the context. So I kind of caught myself when I was relatively young, and you traded a lot of your career. When you're on a desk, you kind of learn when, is this wishful thinking, or do I have a handle on, you're playing probabilities. Am I playing because the probabilities are in my favor, or am I just, looking for the dopamine rush?
Yeah.
And
I spent a lot of time looking at probabilities.
yeah, you have to be able to notice when that's coming up. When you're sensing that, like I write in the book about, people getting very nervous August, September, October 2022, when I went out in the company Slack and said, hey, I'm a buyer of equities here in my PA, in my personal account. And I buying out of the money calls. That's how confident I am. And giant winner. And it made me cocky. And when Silicon Valley Bank got cut in half, I'm like, I'm going to buy some calls in that also, because I'm a fucking genius. And I bought it after it got cut in half, right before it went to zero. So I should have recognized that, oh, this guy is way too cocky. I should have noted that. But I'm like, what the hell? I'm playing with house money. I don't care. You should care.
That's your walking on water indicator award.
Exactly. It's like, look how I am. Who's better than me? And anytime, you never want to attract the attention of the trading gods. My head trader used to say, don't provoke the trading gods. They will punish you. And I like, Silicon Valley, I'm there.
So listen, my friend, I want to keep chatting with you forever, but we got to wind it down. Where can people get a hold of this book? How can they find more out about you, and what should people know?
So you want to learn about the book, you go to hownottoinvestbook.com. You want to learn more about me, Ritholtz.com is where I post whatever I happen to be doing or thinking. Right? That's the big picture. If you're interested in what we do professionally for people, it's ritholtzwealth.com. And, I'm usually findable.
Final endorsement from me. When I have a client, subscriber, friend ask me for an advisor recommendation, a broker, you are the people I go to. I've recently sent some people over, but anyone wants.
Not too long ago, we were speaking to somebody from you.
I just like, these are the people to go to. They're clever, insightful, thoughtful, humble, fun.
Thoughtful and humble. If you could be thoughtful and humble, I mean, it's a great combination. I take that as a really good compliment. So, we've known each other long enough. You've impressed me with your work, and I hope I've impressed you with mine.
For sure. It's been quite mutual, my friend. All right, Barry.
Have a great weekend.
Take it easy, buddy.
Peace out.